Hi, this is Parag Sam. Welcome to this rescheduled talk about split year treatment. We had a few problems this morning. Sorry about that. We're back now, and we're talking today about split year and how you can double up, get 2 tax years for the price of 1, double the allowances, double the tax saving. If you like what you see in this webinar, like it, share it, subscribe to our channel, Product Partnership Living and Working Abroad, and stay connected with us and bring in your expat friends living and working abroad. So let's get into it now. We've talked about, and we talked with many clients about living and working abroad, and about how their day's residence or their work or their family or whatever situation is going to impact them when they're living and working abroad. And this is a key factor. We're not talking about that with split year. Split year is a special set of rules when you're relocating abroad. So if you're going out from or into a country like the UK, that's when you can be living and working abroad and take advantage of a split year treatment. What a split year treatment does, it gives you 2 tax years in one, but it's not black and white completely, as everything with our friends in the tax office. But what it gives you the opportunity to do is to have a personal allowance in 2 countries for the whole tax year, even though you're only there for a short period of time. You get the coverage for that whole period. So how could that work? If you're a tax resident in Cyprus and you relocate to the UK, you can have a 19,500 tax allowance in Cyprus and a 12,500 tax allowance in the UK, all in 1 year. That's 28,000. So it can make a big difference. It can make the difference between high rate tax and low rate taxes. It can make the difference between, £2,000–3,000 tax saving in that transition year. So that's the issue that we're looking at. So let's consider how it works. First of all, and those that know me know that I'm not that good at graphics, but I've done a bit of a graphic for you here. And just to try and illustrate that when we have a tax year, what we have is worldwide income is taxed in the UK. So that's your income, your dividends, your royalties, and your interest are all taxed on worldwide, as well as your gains, your property rental income, and your inheritance tax. The income and the dividends, the interest, the royalties are movable items, they're movable income. So they're taxed where you are tax resident. So if you're tax resident in the UK, you'll be taxed on those movable incomes, those movable sources of taxable income in that year. Gains, rental, and inheritance tax are different. They're fixed in the country where they arise. So if your gains is made on a property sale in Spain, that's where the capital gains tax would be applied. If the property sale is in the UK, that's where the capital gains tax will apply. If it's slightly different with inheritance tax, because inheritance tax is not based upon your residence, it's where you're from. So if you're British, you've got a liability to inheritance tax unless you're a 20-year plus expat. That's subject to a different scenario. So even with split, every UK citizen, domiciled citizen, whether resident or not, is liable to inheritance tax. So that's our graphic there. When you relocate abroad, if you get your residency permit, you can get your tax residency. Once you've got that tax residency number, you can be taxed in that different jurisdiction. There's flexibility to do that on the timings, which is okay. As long as we're doing it prudently and we're not dragging it on. There's a big case that came up in the UK courts after 20 years. HMRC tribunal ruled in favour of the taxman, so that the sale of the Matalan business, when it went public, created a capital gains tax event. The owner tried to go expat and didn't quite do it right, tried to appeal for split year rules, failed to do that. So the capital gain was taxed, and after appeal, it still left the £100 million tax bill at the end of 20 years. So there's a lot of tax that can be saved. So going back to our graphic, you've got movable incomes, which you can manage when you relocate abroad, but the gains and the rental and the inheritance tax will stay with the UK. So when you go expat, what happens is that the movable income is lost, and you're left with still, with the split year treatment, UK liability to capital gains, rental, and inheritance tax. So that's three things to still manage. So even with the split year, you've still got income that's liable for tax in the UK. If it's a capital gain that you want to avoid, if you're a crypto investor, a share sale like Matalan, or an investment sale, you can have a deferred tax as a UK expat and defer that tax for up to 5 years. And to do that, you need to go expat in the year before you're tax resident. So you start the year with a liability to full tax income. During a year, you've still got a liability to capital gains, even though you've used a split year rule. You've still got that capital gains liability. You've still got that property rental liability. You've still got the inheritance tax liability. The capital gains still applies in the year of a split year treatment because that is the rules. Now, if you go expat before the end of the tax year, and then the following tax year, you choose to dispose of investments or have your public business go public, or your business sale proceed, or you decide to sell your crypto, then if it's in the next tax year, you can save the capital gains tax as well. So a split year treatment doesn't protect you from capital gains in the year of your transition. So you can leave in the middle of the tax year, all your income up until the day that you leave, all your dividends, all your interest and royalties up until the day that you leave is taxed in the UK. With split year treatment, then after that time, the only liability you've got after applying a split year treatment is for the capital gains, property rental, and inheritance tax. Okay. If you wait till the next year, then your capital gains is tax-free as well. So, on the basis that with the UK expat, it's a deferred liability. So if you remain expat, you won't pay tax on that gain if you stay outside the UK for 5 years. Property rental income, property rental gains from UK property is always going to be a capital gains and an income tax in the UK. But that's good news, because you could be earning overseas as an expat and still have property rental income to use your personal allowance of £12,500 in the UK. So you're going to earn £12,500 without paying that £2,500 income tax in the UK because you're using your personal allowance. So that is a benefit of a split year treatment. Inheritance tax will stay with you forever. Now, the second thing about a split year is you can't use it every year. You have to stay expat. So the automatic test for an expat, one of the key questions is, have you been outside the UK or inside the UK in the last 3 years. 3 years is relevant. And we're talking about 3 tax years. So if you've been outside the UK for 3 tax years, 3 whole tax years, then potentially gives you the option to use split year returning to the UK. So you've got, you could use split year leaving or returning. So whichever way the relocation is, but you can't use it every year, so use it selectively. So if you go out in April 22 of the UK, you might not need to use split year on your exit, and that's prudent because you've not earned any money yet. Any business income or earnings may well be after that date. So don't earn if you're leaving around the middle of April. But if you're leaving any time later, you want to use your allowances and keep yourself away from high rate taxes, then you could apply a split year treatment. The split year treatment doesn't protect you from capital gains tax. You have to wait till the following April before you start putting the property up for sale or the business up for sale or the making the crypto sale decisions to capitalize that gain. So those are things to consider. When you're returning to the UK, you need to consider and make sure that the disposal of any capital items overseas is done before you get back into the UK. You can't apply a split year treatment, come back into the UK, and then dispose of your capital, your overseas property, while you're now tax resident in the UK. You have to make the disposal before you go back, because again, the capital gain overseas can fall under your worldwide liability. So whenever you're a UK tax resident, you're liable for capital gains on your worldwide income, whether that property is an overseas residential property or not. So think about these things and plan ahead to use that. So split year works very well for the right people at the right time. You need to plan it. If you can plan your split year to take the advantage of the tax differences, so depending on what the tax year is that you're moving into or moving out of, UK is great for using in conjunction with a calendar year tax year, because you've got that 3-month crossover when you can use income in a current year for both periods. So have a think about that as well. If you've got any questions, contact us. You can go to our website at projectpartnership.com. You can jump on our live chat there to ask us questions. If you register, you can book meetings online and chat with the client service team. We're happy to help you, and subscribe to our retained client service for consultant reviews and advice online. If you need more help, more guidance, we've got that available as well. Contact us at projectpartnership.com. So don't forget, like the video if it's good, share it if you're impressed, and get your friends on board as well. Thanks for listening, and sorry about the mess that we've had today with the usability, and I hope you like this, and we'll see you again next time.